Hello and welcome to another video. In this video we're going to be going through the weekly macro themes report. This is the one that we sent out to clients, and this one's from a few weeks ago. Now, just a little background on the report. Each week we cover 5 different topics. This one's pretty good in terms of how it represents it. So we've got a look at the global data pulse, how the global macroeconomic cycle is progressing. Look at bond valuation, so we've developed the bond market valuation indicator here. Look at the components and also a bit of view on the tactics. And then the one that we're going to be talking about today is this one here, monetary policy convergence. Something that I think is going to be a key theme over the next, over the medium term at least. The economic noise index, which is kind of a weird indicator that I've put together, and then a pick through the global equity bargain bin, a look at the bottom tier of global equity markets. Looking at the bottom 10 to 15 cheapest countries' equity markets. That's a good view of what kind of things that we cover in the report, and if you want to learn more about that, just get in touch. We're going to put a link to the website in the video, but otherwise let's get into it. And what we're going to be looking at, as I said, is this one here, monetary policy convergence. The bottom line is monetary policy rates in emerging markets, EM, and DM, developed markets, are on an apparent convergent path. Yet the global GDP weighted policy rate is net decreasing. So what do we mean by this? Well, really it's down to this chart here, the main one, and it shows EM and DM aggregate GDP weighted policy rates. So this is their main benchmark rate, and it's weighted by the IMF GDP metrics. And you can see there in the grey line, that's the emerging market composite monetary policy rate, and the blue line there is developed markets, and you can see that they're going in different directions. One's going down, one's going up. You can see here too, this is sort of showing you how those are evolving by showing the net number of hikes versus cuts on a rolling 12-month sum. And I'll just actually quickly take you over to the latest data over to here, because there has been further ones. You can see that on that rolling cuts versus hikes chart, it's looking even more accentuated here. Actually, if you look at that, there's been the sort of net number of cuts for emerging markets is actually kind of starting to look extreme. It's showing you that they're going through another cycle of cuts, and that's really the message behind this. And you can see that chart's been slightly updated as well. And that's really the message behind this. And before we sort of dive into the implications and the outlook, I wanted to show you these two charts as well. So the one on the left is developed markets composite rate. It's the same one from the previous chart, but it also shows this one here in the dark line. And the dark line is the developed markets shadow composite rate. So it substitutes in the shadow policy rate, which is a indicator developed by Leo Krippner of the Reserve Bank of New Zealand. And that indicator is designed to show the impact of quantitative easing on the policy rate. So it shows you the QE effective interest rate. Now, as you remember, in 2016, Bank of Japan, ECB, BOE, they all stepped up their easing, and the result was about just over 150 bips of effective easing, which occurred, and that was a key driver of how we managed to avoid a global recession in 2016. We came pretty close to it, but that coordinated and well, not coordinated, but the coincident easing, and also some from China, helped avoid that. So now it's interesting to see that that's actually reverted by at least 100 bips, and it will probably continue, as I believe that monetary policy at a global level, certainly for developed markets, is at a turning point. But not so much for emerging markets. They're still firmly in easing mode, and you can see there that the aggregate view across emerging markets has been for substantial easing. And there was some arguments floating around at one point that monetary policy is no longer as effective, or no longer effective. Don't believe that. Monetary policy still has a substantial impact on risk-taking, risk appetite, asset prices, economic activity, and you can see here in the emerging markets chart that the composite leading economic indicator for emerging markets definitely responds to rate cuts and rate hikes. And you can see there definitely in the last 6 to 12 months that emerging market economics have really improved, and that's been a key driver. Both the easing and the improvement in the economics have been a key driver of the really astounding performance by emerging market equities. And when you look at these two charts side by side, the fact that developed market rates are tightening and emerging market rates are easing, that pretty much is a good reason to expect further outperformance by emerging market economies, emerging market assets over developed markets. And that's really a key implication of this theme here of monetary policy convergence. One key implication at a global level, the top-down big picture view is, while developed markets are hiking, and America is a key driver of that, and we're going to expect to see more out of them, that's actually being offset by the easing in emerging markets. So at a global level, policy rates are still trending down, and they might even go lower yet. So, and a key reason behind that, not only the quantum of rate cuts by emerging markets, but the fact that emerging markets are now the dominant share of the global economy. And that's also an important point worth hammering home, because more easing in emerging markets, and should that lead to better economic performance at a global level, that's going to lead to stronger and more resilient cycle. So you might have the US Federal Reserve getting more aggressive on its policy stance, in terms of normalizing or even tightening, but at the same time, the positive impulse from emerging market easing can offset that. So really is a key theme in that regard, at a global level, but also the fact that it's going to, coming back to these two here, just the really very different pictures. So at a high level, it is a picture of convergence, but it's also a picture of divergence, because when one group is easing and the other group is tightening, that is going to drive very different outcomes on economic performance and the performance of their asset markets. So definitely one to have on your radar. And of course, when you have divergence going on, it creates opportunities, but it also creates risks. If you take it to its extreme, if you extend these trends even further, at some point that'll start to create, volatility catalysts. It's certainly going to drive some interesting risks and opportunities. It's going to be a key theme for us too, and we'll probably be going to be building on this theme in future reports in terms of the implications and where to find the best opportunities, and also where to be guarding against your risks to the portfolio. So that's it, and hope you enjoyed the video. If you like this one, please go ahead and hit the like button on YouTube, and be sure to follow the channel, because we'll be doing more of this. And I'm also going to be launching a new video series later on this week, so stay tuned for that.